Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey Prime investors, Martin Maxwell here, and welcome back to our special series on mastering the mortgage. Last week, we opened up the borrower's toolkit and deconstructed your monthly payment. You learned the essentials: PITI, APR, and the strategic choice between a fixed rate loan and an ARM. If you haven't listened to that episode yet, I highly recommend you do. It's the foundation for everything that follows. Today, we're zooming out from your personal loan document to the global stage. Mortgage rates seem to appear out of thin air, set by mysterious forces. But it's not magic. They are the product of a massive interconnected financial engine. Today, we're looking under the hood to see what really drives the numbers. Let's get started. The first thing you need to understand is that your mortgage rate isn't really set by your local bank. It's priced by the global bond market. And the undisputed king of that market is the 10-year U.S. Treasury note. Ever notice how news reports about mortgage rates almost always mention the 10-year Treasury? They move in near-perfect lockstep. Why? Because while your mortgage might have a 30-year term, the average homeowner sells or refinances in about 10 years. This makes the effective life of a mortgage very similar to a 10-year bond, so they're priced against the same benchmark. But the real work happens in a place called the secondary market through something called mortgage-backed securities, or MBS. Here's how it works. Your lender doesn't want to hold your 30-year loan on their books forever. So they bundle your loan with thousands of others into a giant package, an MBS, and sell it to big investors like pension funds or insurance companies. This is a brilliant system because it gives your lender fresh cash to make new loans. It's the system that keeps the entire mortgage market liquid. And here's the core mechanic. The price those big investors are willing to pay for that MBS package directly sets your interest rate. If global investors are hungry for MBS, they'll pay a high price, which allows lenders to offer lower rates to you. If investors are nervous and demand is low, they'll only buy at a discount, which forces lenders to charge higher rates. Your mortgage rate is a direct reflection of global investor demand. So what makes those global investors hungry or nervous? They're constantly watching the economic weather, and 3 signals matter more than anything else. First and foremost is inflation. Inflation is the arch enemy of a bond investor. If an investor buys an MBS that pays them back a fixed amount of money over 30 years and inflation is high, every dollar they get back is worth less. To protect themselves, they demand a higher return, a higher yield, right from the start. That demand for higher yields translates directly into higher mortgage rates for you. Second is economic growth and employment. Here's a paradox for you. Good news for the economy is often bad news for mortgage rates. A booming economy with lots of jobs and rising wages makes investors worry about future inflation. So they sell bonds and rates go up. A weakening economy has the opposite effect. Inflation fears cool and rates tend to fall. Finally, there's global uncertainty. Geopolitical conflicts, trade wars, a global pandemic, any major crisis can trigger a flight to safety. Investors around the world pull their money out of risky assets and pour it into the safest investment on earth, U.S. Treasury bonds. This massive demand surge drives Treasury prices up and their yields down. And because mortgage rates follow the 10-year Treasury, a crisis overseas can actually cause your mortgage rate here at home to drop. Now, let's debunk the single biggest myth in real estate finance, the idea that the Federal Reserve directly sets mortgage rates. They do not. The Fed has direct control over one thing, the federal funds rate, which is the very short-term rate banks charge each other for overnight loans. This rate influences things like credit cards and car loans, but it has very little direct impact on a 30-year fixed mortgage. So why does everyone hang on the Fed chairs every word? Because the Fed's true power is its ability to shape the market's long-term expectations about inflation. The Fed's job is to keep inflation under control. If the bond market believes the Fed is credible and will do whatever it takes to fight inflation, investors feel confident and they'll accept lower yields on long-term bonds. This helps keep mortgage rates down. But if the market loses faith in the Fed's resolve, investors will demand an inflation risk premium, and long-term rates, including mortgages, will rise no matter what the Fed does with its short-term rate. The Fed isn't the rate setter. It's the conductor of market psychology. Okay, last piece of the puzzle. If you look today, the 10-year Treasury yield might be 4.5%, but a 30-year mortgage is 6.5%. Why the huge gap? That 2-point difference is called the mortgage spread, and it's the premium you pay for the unique risks and costs of a mortgage. It's made of two main layers. The first is the secondary spread. This is what those big MBS investors demand as extra compensation for two risks that a treasury bond doesn't have. The first is prepayment risk, the chance that you'll refinance when rates fall, paying them back early and robbing them of future interest. The second is default risk, the chance you won't pay at all. The second layer is the primary secondary spread. This covers your local lender's costs, their operational expenses for staff and offices, their servicing fees for collecting your payments, and of course, their profit margin. So your final mortgage rate isn't just one number. It's the 10-year treasury yield plus a premium for prepayment and default risk, plus another premium for the lender's business costs. It's a complex, multi-layered price, and now you know exactly what's inside. The big takeaway today? The rate you're offered isn't arbitrary. It's the result of global demand, economic data, the Fed's credibility, and a multi-layered risk premium. Understanding these forces moves you from being a passive rate taker to a knowledgeable investor who can anticipate the market's next move. Your challenge today: go to a financial news site and look up the current yield on the 10-year U.S. Treasury note. Then look up the average rate for a 30-year fixed mortgage. Calculate the spread between them. Is it wide or narrow by historical standards? Just doing this simple exercise will get you in the habit of thinking like a macro investor. Next week, we bring it all back to you. We've covered the massive forces you can't control. Now, we'll deliver an actionable playbook to get the best possible rate, no matter what the market is doing. You won't want to miss it. Thanks for tuning in. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one smart move at a time.